Still looking at consolidation. Remember, we're looking at consolidation of statement of financial position. That is what we're still looking at. And if you remember, I mentioned to you that I want you to have a structured approach to it. And I gave you 7 steps that you need to use. The initial 7 steps. And if you also recall, the 7th step, 1, 2, 3, 4, 5, 6, 7. The 7th one is when you start to consolidate. I'm sure you have seen the previous video where I went through each of those 7 steps, and I also used an example to practicalize how you can apply the 7 steps. And I said the 7th one, which is consolidate, you can now approach it in 5 steps. I need you to practice your consolidation every time. If you need to write those 7 steps and the 5 steps on a paper or on a sticky note until you are comfortable, please do that. Don't do your consolidation just as you feel. Have a structured approach to it. Right. The 5 steps, let me remind you quickly. I said the number 1 is to remove the investment in subsidiary and the share capital of subsidiary. And I said step 2 is to make necessary adjustment. The necessary adjustment here is what I want to talk about today. So today I'm going to be talking about all possibilities of adjustment that you can face. I'll look at all of that today. I will start today, and we'll see if we can't finish, we'll go into the next video for the other adjustment. After making adjustment, you're supposed to now combine all assets and liabilities. Then the 4th one is to calculate the group retained earnings, and the last step is to calculate the closing NCI. Right. These are the 5 basic steps to your consolidation. But remember, before you get to the 7th stage of consolidation, there are a few steps that I gave you earlier on these 7 steps when I told you that number 1, do your structure, which means you will draw it. The consolidation does not start just by adding figures together. Take it step by step. In your structure, you have the percentage holding, the date of acquisition, you will state it there. I remember I told you that once that is done, you calculate your consideration, which is the cost of acquisition. After then, you calculate the net asset and opening NCI. Then prepare your templates. Remember, all of that we went through it. Prepare your goodwill as well. All of that are in the previous 7 steps. The 7th one is when you start the consolidation process. Right. But where I want to focus on today, that's just a revision of what we've done before. But what I want to focus on today is this number 2, adjustment. So my focus today is on consolidation adjustments. And I've seen a lot of comments from all of you. Someone asking for how to make adjustment for unrealized profit, fair value, and all of that. So that is exactly what we want to start looking at today. So what are the things we'll be looking at? We'll be looking at intra-group transaction, intra-group transactions. And under this intra-group transaction, that's when we will be speaking on unrealized profit, which is very popular, and from my experience, one of the areas where students struggle a lot. But I want to promise that after this video, I don't imagine that you will ever struggle again. Just pay attention and let's keep going. Right. So for the intra-group transactions, it can be balance sheet items or P&L items. For balance sheet items, this can be things like borrowings, receivables, account payable, and P&L items are the trading items. But we'll look into all of them in details. Right. The second adjustment we'll be looking at is the fair value adjustment. And remember, what it's all about is at acquisition, you expect or you are required put it like that. You are required to value the net asset of the subsidiary at fair value. So sometimes if the fair value at acquisition is different from the carrying value, you need to make that adjustment because you need to use the fair value and not the carrying value. But we'll get to details later. There are also other forms of consideration that we need to look at. Not all the time you have a subsidiary being acquired at cash. Sometimes shares are being used to make payments. Sometimes there are contingent payments that are involved as well. And lastly, I'm going to speak on mid-year acquisition because you have to be careful when you have mid-year acquisition, especially when it gets to a point where you need to start calculating retained earnings. It makes a lot of difference. So I'm going to look at all of this. When we finish this 4 adjustments, then we can now finally move on into a full exam question on consolidation of statement of financial position. And once we do that, we'll be done with statement of financial position group account. Now, let's take each of these one after the other, and I'm going to start with intra-group transactions. So let's look at intra-group transactions. So I'm looking at intra-group transactions. What are intra-group transactions? How do you know something's an intra-group transaction? It's easy. Yeah, it's just transactions between members of the same group. And in the previous video, I've explained what a group is. A group is a combination of parent and subsidiary, might be parent and 2 subsidiaries, 3 subsidiaries. Once you have relationship between parents, associates, subsidiaries, they are members of the same group. So you can either have transaction between parent and subsidiary, or it can even be between subsidiary. So subsidiary and subsidiary, when you have more than one subsidiary. So those are transactions between those guys that are referred to as intra-group transactions. An example is you can have account receivables and account payables, which is when you have some form of lending or borrowing taking place amongst the group members. Likewise, you can have trading transactions. And what are we talking about here? When a member of a group is selling and the other party is buying, and both of them belong to the same group. So that is what it is. But it's not just knowing what it is that is important. The most important thing is knowing the rule. So in consolidation, what is the rule when you identify intra-company transaction? The rule is very straight and direct, and you must obey the rule. The rule is just saying that eliminate it. We don't want to say it. Eliminate it. So what are you eliminating? You are eliminating whatever is left at the reporting date. So whatever is left in the financial statement at the reporting date. That's the rule. Eliminate it. Take it off. We don't want to see it. Remove it. Remove it. And why do you have to remove it? Because remember, it is single entity concept. When you are doing consolidation, a single entity. So you cannot lend or you cannot borrow from yourself. You cannot sell and buy from yourself because you are seen as a single entity, as a group. So that is why you have to always eliminate intra-company transactions. The second part of it is when there's a cash in transit between members, that you cannot eliminate the way you eliminate other transactions because cash is cash. Whether it's moving from point parent to point subsidiary, it's the same cash that is living and moving. So in consolidation, they are all added together. So in that case, all you need to do, the rule for cash in transit is add cash in transit to its destination. Yeah, what I'm saying here is just fasten it, assume that it's been delivered. Yeah, so it's in transit. However, it has not arrived to the subsidiary or to parent where it's supposed to be. When you are doing your consolidated financial statement, you need to assume that it has arrived where it is meant to be, right? So that is the rule. So you know what it is, and you know the rule around it. Now, how do you apply the rule? How? This is where it gets tricky. Please pay attention. This is where it gets very tricky. And it is not meant to be tricky. It is extremely easy if you pay good attention. The first thing I'm going to tell you is how is by understanding your debit and credit entries very well, because that is what you need to understand. If you just understand debit and credit, you will understand this easily, because it is not as complicated as it looks, right? But I want to tell you that everything we do in consolidation is debit and credit, from consolidation to adjustment to everything. So every time you need to do anything, ask yourself, where am I debiting? Where am I crediting? Once you're able to figure that out, you will start building confidence and you'll be very solid and comfortable. So let's start with the easiest one, which is the balance sheet or statement of financial position items. So sometimes you have account payable in one statement, you have account receivable in another entity. How do you eliminate? And we have to use debit and credit. So let's just work an example quickly to deal with this. I think I have one example I can share with you. Okay, let me see, not this one. Yes, this one. Let's choose this one. So look at this question on my left side. You have the receivable, you have the cash, and you have the payables. For Paint, which is parent, and Steam, which is the subsidiary. And included in Paint receivable is $1,700 that is due from Steam. Steam had sent $200 to Paint, but still in transit at the reporting date. Now we need to calculate the account receivable, account payable, and consolidated cash balance. So this is, we want to calculate the group figures for all these three items. And remember, I said everything is debit and credit. Now, how do you deal with that? We said eliminate all transaction. 1,700 is what is included in this Paint receivable, due from Steam. This 13,000. Normally, we're supposed to just add 13,000 plus 11,700. We will do that, but it does not end there. So we want to do account receivable first, which is 13,000 plus 11,700. However, we need to eliminate this 1,700 because it's a related party transaction. So we'll do minus 1,700. And that will give us the group. The second question says consolidated account payable. So we need to check what will be the group account payable balance should be. If you look at the question, we have 16,330 and we have 10,870. So which means we need to add those together, 16,330 plus 10,870. However, in that payable, because Steam has already sent 200 to Paint, Steam will not have up to 1,700 payable to Paint again. So which means Steam only has 1,500 as amount that is payable to Paint, because in his own, and I'm going to go through the entry. Remember, when he sent this $200 that is in transit, he would have debited account payable and credited his cash with 200, thinking that he has reduced the 1,700 to 1,500. So that is why the account payable balance will be equals to that 16,330 plus 10,870 minus 151, and that will give us 25,700. That is the group account payable. I remember cash, group cash. I told you whenever you have cash in transit, the rule is that, what is the rule? You add to destination straight away. Like you're going to fast track the delivery of that cash, to put it like that. So which means you add this together and also you add the cash that is coming. Plus 213 plus 200. And all of that will give us is 413 plus 190, that is 603. And that is the cash. So we've done the elimination like this, but I don't like to just add figures like that. I like to show you the debit and credit because that is how you're going to get comfortable with consolidation. So starting from the receivable part, what have we done? What we have done is that we said we want to create a group account. So to create a group account, we need to move all these balances to the group account. So the first thing is we're going to debit the group account with those two receivables. So debit group account 13,000 and 11,700, and we're going to credit each account to take them out. So we'll credit paint and we'll credit steam. Paint, we took out 13,000, so that we'll move it to the group, and steam, we took out 11,700. However, it's not going to stop there. This is just moving the balance to the group account. There's an adjustment that needs to be done, which is inside this receivable. The question says there's 1,700 that must be eliminated. So to eliminate it, we need to take it out of that 13,000. So which means we're going to debit account receivable of paint 1,700. And where do we need to credit? Normally we need to, because we are removing it, so we're going to be crediting account receivable. So we're going to be crediting the account receivable because we need to remove it. Remember, account receivable is a debit balance, so to remove it, we need to post opposite entry to reduce it. So that's why it's going to be a credit to account receivable of 1,700, and that is the minus that you are seeing here. That is a credit to account receivable, right? Then where do we debit? Naturally, we should be debiting account payable of the subsidiary that we're eliminating against it. So we debit AP of steam. However, not 17, because steam does not have 17 in his account. He is going to have just 15 because he believed that he has sent the 200 box here, and that will be 1,500. Then the remaining 200 is the cash in transit, which will now be added to the paint. Remember, to destination. And that is this debit of 200 to cash is this you are seeing here. This debit to AP of 1,500 is what you are seeing here because we are reducing the AP. And this credits to account receivable of paint of 17 is this reduction that you are seeing here. So I always like you to understand consolidated financial statement with debit and credit. Likewise, all the adjustments, you must be able to figure it out with understanding of debit and credit.